Well, tēnā koutou katoa, Mōrena, greetings everyone. Very pleased to see we have an audience here with all of the excitement happening everywhere else. I'm Adrian Orr, I'm the Governor of the Reserve Bank of New Zealand, and I am ably supported here with Chris Bloor, who is one of the chief editor, the editor-in-chief, I would say, of the Financial Stability Report. That's a new title for you, Chris. And our Deputy Governor, Jeff Baskand. I'll just cover off our key statements and then business as usual, we're open for questions. The New Zealand financial system remains resilient to a broad range of economic risks. However, financial system risks are elevated and ongoing effort is necessary to bolster system soundness and efficiency. Domestically, debt levels are high in the household sector and dairy sectors, and that does leave borrowers and lenders exposed to unanticipated events. Similar challenges exist globally, given current high public and private debt levels and stretched asset prices in many of New Zealand's trading partners. The capacity for some of these foreign governments and central banks to respond to unanticipated negative events is also limited by their high current government debt and low nominal interest rates. This makes it important for us to make the New Zealand financial system resilient while the conditions are conducive. Increasing financial institutions' capital positions is central to ensuring they can withstand severe shocks. We have, as you well know, proposed higher capital requirements for banks and are currently reviewing a significant number of public submissions on these proposals. There is also a need for some insurers and non-bank deposit takers to improve their capital buffers. We will be reviewing insurer solvency standards in the months ahead. Further resilience also includes service providers taking a longer-term customer outcome focus to both maintain confidence and promote sound resource allocation. We will ensure banks and insurers respond to the issues identified in our recent review of their conduct and culture that we did jointly with the Financial Markets Authority. A longer-term focus is also necessary for financial firms to adapt to the changing competitive, changing regulatory and changing climate environment. Insurers are changing how they manage their exposure, for example, to natural disaster events, and this is altering profitability. Risks associated with climate change are also impacting on the accessibility of insurance, which will have potential flow-on effects into the banking lending. These risks must be appropriately identified, managed and priced to ensure a smooth transition over coming years. The Reserve Bank's loan-to-value ratio restrictions, we believe, have been successful in reducing some of the risks associated with high household indebtedness. The current LVR remains appropriate. We're leaving it where it is, with any further easing subject to continued subdued growth in credit and house prices, and banks maintaining, in particular, prudent lending standards. Ngā mihi, thanks, and we're open for questions.
Hi, Nigel Sterling, New Zealand Farmers Weekly. Just talking to the trading banks about the minimum capital proposal, they believe that the outcome of that for rural lending in terms of basis point impact will be higher for farm loans because of the more capital that has to be held against each dollar of lending relative to the household sector. Is that how you see the possible outcome? And have you done any modelling on the 20 to 40 basis points that you've talked about, where the basis point impact would be for farm lending?
So we are at this point reviewing all of the submissions. Obviously, I'd have to say half the submissions came in on the last day, so it was very similar to school kids sitting exams. I think we arrived with a very large pile of them. We are working through the information we've received, and we're also aware of the claims made by some banks around the impact on margins for the rural sector in particular. And in fact, there have been an open public letters saying this. We do need to review just what sits in there. I would remind all customers that the banking sector is competitive. I'd remind the banking sector that it is competitive, but without doubt there are high pockets of debt out there. The banking sector, those who are lending to some of these more extreme debt levels, we have been raising alarm bells for quite some time, and the banks themselves are working through how to best manage through this situation. So it's a bank-customer relationship in a competitive market. The relationship between capital and end outcomes could be lower or higher retained earnings by banks. It could be higher margins if and where they can put that in place. There's a whole range of potential outcomes. On the 20 to 40 basis points, our workings have been available to everyone. I know we've had lots of claims there's no cost-benefit analysis. The whole proposal which has been out there since December is based on a net benefit relationship, and so that's where we come with the 20 to 40 basis point shift.
Do you have a number for the farming sector?
Sorry?
Do you have a number where for the impact would fall for the farming sector in that?
I don't have
40
that,
point?
no.
No, we don't have a specific estimate by sector. I mean, the total capital requirements shouldn't actually change the relativities per se. So it's a choice by banks and how they wish to allocate that and what the marginal if you like, cost of lending to a particular sector is. They make the risk-return allocation decisions there. There are some historical issues here where perhaps probably rates of return in some sectors have been below those in other sectors. They appear to be considering now whether what they've tolerated for some years is something that they're less tolerant of, and so choosing to talk about allocating less capital, if you like, or repricing more in some sectors. But that's commercial decisions as opposed to a consequence of the aggregate level of capital, which is indifferent between the sectors.
Yeah.
Just one more question. Do you see any risk if the banks can't raise that capital either from their parents or retained profits? I think you've talked about 70% of their I'll just finish of a run on rural land values. If the banks react by cutting back rural lending because it's the riskiest form of lending?
No, we don't. The banks are very profitable. They're amongst the most profitable in the world. In fact, I think there's a diagram in there. They sit there, I think, about number 3 in the world. So profitability is fine. They have good access. They have very good credit ratings, good access to other capital. And we're also talking about a transition over many years. And so there are many parts of the story that get lost in the excitement there. As the Deputy Governor mentioned, it's the aggregate level of capital. It's not the relative allocation. The relative allocation is a business decision. Access to capital has many means by which they can do it, and I'm not sure how or why a bank would wish to set off its own demise through some type of short-term behaviour. So.
Hi, I'm Janae Tibshirani from interest.co.nz. I just have a question about risk-based pricing. To what extent are you concerned that insurers are using this as a money grab? That insurers are using risk-based pricing as a money grab?
We are right amongst it at the moment, really trying to get our heads around working with the industry in part for exactly that. Sunlight is a great disinfectant. One of our concerns for climate change are multi, in the sense that insurance will evolve, better pricing needs to evolve, people need price signals to make their decisions for a smooth transition. But on the other side of it as well, we don't want to see prices rise in some areas and not alter in others, or being used, the asymmetry of information, I would say. So it really is an onus on customers and the businesses themselves to fully explain how they are behaving and why they are doing that. That is part of our ongoing work. Anything to add, Chris?
I think that covers it.
The risk-based pricing we've seen to date has largely been around earthquake cover, and it seems like it's moving towards climate risk and flood risk. How quickly do you see risk-based pricing sort of moving more towards that flood risk side of things, in addition to quake risk?
I think we might as well consider it here now. The mere fact we're talking about it in a situation like this means that it's on people's minds. It's a competitive industry, of course. We'd like to see it more competitive. It's quite a highly concentrated industry in this country. But globally, the reinsurance market is well awake, well aware of these issues. New Zealand is a small country, able to be diversified across broader portfolios. So we're not seeing any particular drama going on in the background reinsurance market, but in our competitive market at the moment, people are thinking really hard about what can I insure at what price and for how long. And I think that should be front brain for all consumers and investors as well. This is the wonders of a financial market. They are bringing these future risks into current decision making.
Sorry, I just have one more question. Is there a point at which the Reserve Bank will intervene in any way in this area?
Well, I think our single biggest challenge, of course, around Prudential is to make sure that the insurance business is lending in a sustainable manner and that they have adequate liquidity capital provisions for themselves to do that. So on the one hand, we're very eager that they think hard about these issues. Likewise, we want an efficient insurance sector. So we want transparency around how these prices are happening. So we're on both sides of the equation, and we'll be working very hard, as you see in this financial stability report. It's our first steps. It's about seeing who's awake at the wheel and who's doing what about any of these issues. Everyone's awake. Are they doing enough at the moment? No, it's very early days in New Zealand for the financial industry and the insurance to be thinking more accurately about that. Have I undersold anyone, Chris?
No,
I'm doing well, aren't I, Chris?
good job.
Hi, I've got a question for Jeff Baskin. You said something earlier that I didn't quite understand when you were talking about...
Sorry, can you introduce yourself, please, for the camera?
Sorry, Jenny Ruth from Business Desk. I didn't quite understand what you were saying when you said that banks are deciding where to lend across sectors is a commercial decision, but then you talked about them being indifferent about something. I wasn't sure what that meant.
I talked about our total capital level being indifferent on a sectoral basis. That's a total amount of capital they have to hold, and they have to allocate that and choose to allocate that in relation to risk and return. So
allocating it is the commercial part.
This is the commercial part, correct. So if they reprice some sectors more than others, that's not a direct consequence of the level, or of our proposals to raise the minimum required level. That's decisions they're making on capital allocation themselves.
Back in November 2017, I asked a number of questions about sorry, my mind's just gone blank. Maybe someone else.
There's Matthew Brockett right there.
Yeah, Matthew Brockett from Bloomberg News.
Greetings.
I just wanted to ask a question that I think you've already been asked many times, but there's been some recent reports that you are offering an olive branch to the banks about your capital proposals, and I just wanted to ask again, I mean, you've mentioned you're flexible on areas such as implementation times and so forth, but are you actually flexible on the level of capital? Is that an area that you're prepared to compromise on?
We are open-minded, and we've said this right from the outset. That hasn't been the reaction from the industry that we have been looking to increase the capital with. We have only just received the material, and if we see sufficient reason to be changing any of the parameters, we will. And we'll make it clear why we did. And as you saw, we've announced we've got 3 global experts as well. We've got the net benefit proposals. We are wide open to do the right thing by the country. But we want more capital, we want good quality capital. in this country because it's the well-capitalised banks that are, in the long term, the most sustainable and profitable.
Okay, and just one further question about the recent decisions around ANZ Bank. I just wanted to ask, you mentioned in that release that they'd been using this unapproved internal risk model since 2014. Could you explain to us how it is that that occurred for so long before action was taken? Is there something in the process where...
I probably need to correct it. By the way, there's been so much misperception, in fact, by one journalist in here around what did or didn't happen. So just for the record, it was April 2019 that we were alerted by the ANZ Bank that they thought they were using a model that was not switched on.
And there's nothing...
And the date of announcement was the choice of the ANZ Bank. So that's quite different to a story that temporarily arrived on the news yesterday, and I wish that facts would stick there. How did it happen since 2014? We assign and agree whether they can or can't use the models. They then use the models, and their board of directors and management attest to the fact those models are being used. The attestation failed. And that was what is in the headline there. It was in 2017 that the Reserve Bank said, go and show us how and whether these attestation frameworks are working or not, and it was through the ANZ Bank's follow-up on our requests that they discovered they were using a model that was not switched on.
And are you going to re-look at those processes to see
We are.
how you can stop that happening?
We are.
Right.
And it's a continuous challenge for this bank because, you know, half the world wants us to allow the banks to get on and run their business and allocate their capital. The other half wants us to be all over them, regulating every inch they do. If we're all over them and regulate every inch they do and they fail, well, then whose problem is that?
Is there
And so on.
a resourcing issue there? Do you need more resources?
We need a better conduct and culture and positive affirmation from the banks themselves to continue to earn the right to be using advanced models, because an alternative is a standard model.
Thanks.
Bernard Hickey from Newsroom Pro. Good morning, Governor. Could you tell us what has changed in the last 3 or 4 years that has led you to propose increased capital requirements? Because when I looked at past financial stability reports, they were pretty sanguine about both the risks to the banks and their capital levels.
I think I'd answer it in this way, Bernard, and greetings, is that not enough has changed, and that what has changed is not sufficient, and which is why we want higher capital. When you think since the global financial crisis, household debts have actually increased, government debts have increased, interest rates and low nominal interest rates globally have fallen, the room and ability to go and survive through another global financial crisis is tighter. Insufficient change has happened. In New Zealand, we've made some very good changes, but still insufficient. Liquidity requirements of the banks are much stronger now. We have longer duration of bank lending so that we are less held up by real-time refinancing, and we have more domestic funding going on, so we are slightly less reliant on global funding. But we are still as exposed to all of the risks that we were there during the GFC, and in some cases from a more heightened position. In between time, we've had challenges around the conduct culture, and also we've had more experience around what can be achieved through self and market discipline versus straight up simple capital skin in the game. So we are not doing this alone. We are part of a global shift of regulators to higher, better and more transparent capital. We just happen to be doing it for New Zealand rather than other foreign countries.
And the Bankers Association submission based on Graham Scott's research argued that the capital increase would increase costs for consumers and businesses by, I think, $1.8 billion a year, assuming that their profitability levels weren't reduced. What's different between your estimate or expectation about the costs and that one? Why do you think it's not going to be so much of a problem as the $1.8 billion that Graham Scott suggested?
Well, we're very confident it isn't. We will be working through all of their reviews. There are differences around calibration. You made a great assumption there that bank profitability may not change. I'll be interested to see how investors manage that one. So, the devil's in the detail of the assumptions. And
You argued.
there was also, what was one of the interesting ones from NZBA, that at the end of the day, if banks fail, it should be our fault and we should pay them out anyway. So this is the difference in levels, and you have a look at that. It's in the NZBA, which I find astounding. So, there are a lot of interesting assumptions across a lot of the submissions, particularly from those who are the ones who may be facing higher capital requirements.
You've argued in the past that competition would help, would mean that the banks would be forced in a way to accept lower profitability and not have to push so many dividends back to Australia. What makes you think that the other banks beyond the big four have the capital levels or the market presence or the people to really compete with those big four, to compete down those profitability levels?
The same information you have. You have customer choice across a broad range of banks in this country, and if people are operating collusively or as cartels, well, that would be an issue for the Commerce Commission. So that is the reality of it. Can I just step back and think about, just for a second, because this is where people get lost. We're not asking this transition to happen tomorrow. We're asking for it to happen through time. So it's not something that's going to be switched on. If banks are choosing to use this as an excuse to change their current business behaviours, then that is a customer decision whether to be remaining or asking questions about that. Because we haven't even talked about where we're going, let alone the period of transition over which we're going. If some banks choose not to be an agricultural sector, then they need to be upfront and honest that that is their business choice and not hide behind a potential future outcome.
Sorry, I've remembered what I was going to ask. In November 2011, I asked a number of questions about the IRB models and the Westpac situation, and both you, Mr Baskand, and Grant Spencer continued talking as if you were still approving new IRB models, and yet we now know that about a year before that, you'd written to the bank saying that you would stop, you didn't have the resources, I understand, maybe that's wrong, that you weren't going to assess any new models from then on. And I understand there was a follow-up letter in May 18, basically making that indefinite. Why didn't you tell us then that, what the banks had already had approved was it, as far as you were concerned, for the foreseeable future?
Did you say November 2011?
Yeah.
I don't remember being here then, but...
Well, we've got the recording. I listened to it the other day, and both you and
I
Grant
was government statistician
Spencer.
at that time, but I certainly wasn't at the Reserve Bank then.
Sorry, November 2017.
Okay.
So you said 11, so is it 17?
November 17, that's
Okay.
The issue with Westpac was that they were using models that they hadn't had approved. So as the Governor said, the process is that banks, IRB banks, need to get models approved by us and keep them approved, and there's a compendium of approved models that we have. They had been making model changes repeatedly for a period of time, and operating models that were unapproved. It's different from the ANZ case in the sense that they weren't even operating a model, it had been decommissioned. But the essence is that banks are required to operate approved models. At times, those approvals are delayed, waiting for us to scrutinise or review those models. And we did put a model, what we call a model closure window on, where we said that for a period of time we were not able to approve new models. The obligation then on banks is to continue using the existing approved models or models that, that are approved.
But why didn't you tell us? I mean, it seems like you told the 4 IRB banks, but we've only just learnt about that now.
I don't think it's been a national secret, Ms. Ruth. I mean, we've said use the models that we have approved, full stop. What have we seen? Some people not using the model, some people using models that haven't been approved, full stop. Meanwhile, our business is taken up by many things other than just approving new advances to IRB models, full stop. Have we got any other questions?
Can I just have one more, please?
No, have we got any more questions?
I've only asked two. Other people have asked.
By the way, you've asked many questions along this path, and we have some issues to clear up with you about factual mistakes that you have repeatedly put on the media. And so, hence, I'm feeling a little bit disappointed with having to go over and over this issue unless I can find a particular reason to it.
I was actually going to ask you about what's probably
Janae, we're happy to follow this up afterwards, which we said before, Janae.
The report says that all insurers except for one are meeting their minimum solvency requirements. Is that one CBL Insurance or is it a different one? Okay.
Yep.
CBL.
And just another question. In terms of the Reserve Bank's online systems, how many attempted hacks does the Reserve Bank get roughly per week?
I don't have that statistic at hand. What I can say is we have significant protection systems, we have significant detection systems, and we have significant recovery systems. I don't like to talk about them too publicly so that they can remain significant on the way through. So. Jenny, do you want to? Oh, sorry, Richard.
Richard Herman, Politic. In the light of what's happened at the Reserve Bank, have you requested any assistance from the Cyber Centre to check your own systems and the way they performed over the last few weeks?
We work close and real time with global experts, and I'm sorry that I have to say that quiet because obviously we have significant challenges here, particularly around the real-time gross settlement system. So we do our best. Will that forever be the best to stop someone from doing something? Who knows?
Governor, could you give us a sense of how the banks are treating their different types of customers and risks in terms of how willing they are to give credit and what sort of margins or interest rates they're charging? Because there has been some commentary in recent weeks that the banks are being even tougher and charging relatively higher interest rates for business and particularly rural lenders.
Yeah, we don't have anything that's shining through in our aggregate statistics that say that, so I'd just be using anecdotal stories as much as yourselves. Chris, do you have?
I mean, I point to our credit condition survey that's on our website, which shows banks' attitudes, their pricing, and their non-price credit factors to a range of different sectors. So I suggest you look at that to what banks are saying they're doing to different sectors of the economy.
And have you seen the banks pass on the recent official cash rate cut in a way that you're happy with?
What's been the pass-through?
Most estimates put the pass-through have been at around 15 basis points or thereabouts. So, but it's still working its way through, partly in the spread. So how much it's going through in deposit and how much it's going through in lending rates. But on lending, probably about 15.
And are you happy with that?
Well, it's just, I think these things do change over time, and again, those competitive pressures and there are a number of factors that are in banks' overall funding costs. So as deposit rates change, as overseas rates change, so it's always a little hard to expect and assume that it's immediate full 100% straight from an OCR straight into mortgage rates. Also, fixed rates have been falling quite sharply through the year, so it's probably the other main significant factor is, in a sense, there was quite a lot of decline in rates ahead of the OCR as people were anticipating a cut. So actually, if you look at rates, I'm not sure what the total movement is over the year, but they've certainly come down quite a long way.
On that pass-through number, have you got a comparable number for the rural lending? How much of the OCR cut was passed through to rural loans?
No, I don't, sorry.
Just one quick one for the Governor. What would be your message to the most highly indebted dairy farmers? This is I think it's the 20% of farmers that account for 30% of the debt or something similar to that. I mean, I think you say here that those farmers, even at the current payout, are struggling to break even. So if there is an increase in lending rates, then presumably some of those farmers are going to struggle even more greatly. So do you have a message for them?
The vulnerability is real. I imagine that they feel that all day, every day. Your relationship with your bank is critical because banks are meant to be here through good times and bad. Often it would have been the bank that they're talking with who advised and lent the money to begin with. So that relationship is very important to maintain. Banking sector is still highly profitable, so they need to think about that. The other parts is too often debt arrives when equity is actually needed. And we've seen this often in large part through the short-term nature by which too much long-term farming is funded, which is through the debt rather than the equity avenue. So think hard about third-party equity, how you might dilute some of that debt on the way through. And I am aware that, there are many people thinking hard around how to provide access to different forms of capital rather than just bank loans to make these businesses more sustainable. The last bit, if they're starting to feel slightly comfortable, which I doubt about everything I just said, understand also that it's probably going to get harder, not easier, from here as well, because the expectations on the rural sector globally is changing. And that, again, is about getting yourself with the flexibility to be able to evolve into a sustainable, environmentally sound farm. So this is the nature of the business they are in. I asked if you wanted another question.
And so have others. I'm managing as best as I can. We will get it back to you in just a second. Yes, that's fine.
I just have a question that's mildly related to financial stability, and this is in regards to cybersecurity. Has the Reserve Bank changed any of its cybersecurity processes further to Treasury last night, going to the police in regards to an alleged hack?
No.
Thank you. You said, Mr. Orr, that you expect the new capital rules to be phased in over time, but we seem to have seen time and time again when new changes are introduced, like LVR restrictions, new restrictions announced, the banks tend to start working on the new rules straight away. They don't tend to say, we've got 5 years, we can sit back and gradually relax.
Yeah, again, I just ask people to talk to their banks about that. That is what we can do, but we can't help every customer do these issues. It will not be the regulatory impost that is making them move. They may decide that it's advantageous to go sooner, later, or indifferent. We just want to know that they are going there.
And one last question. The fact that you did decide to stop processing applications for new models, does that suggest that the prudential side of the bank needs more resources?
We need more resource. We've said that very often, and that was in part one of the outcomes of the IMF's financial sector assessment program, and was also a request from previous governors of the Reserve Bank. We have not been funded more resource. We are getting all of the signals now that perhaps more resource is a useful thing for a central bank. That's why we have to prioritise our work, and banks have the choice of the same advanced model or standard models, and or working to our timetables. Ms. Bernard?
Just one more. The APRA announced last week they were going to remove a prescription for the banks that they stress test mortgage lending to a potential interest rate of 7%. So when interest rates go up, can you make the payments? I know that from memory that prescription is not put in place by the Reserve Bank here, but how do you feel about what the banks are using in their own internal stress tests around mortgages, given some people say interest rates have, permanently dropped onto a lower level?
I think just at the high level, and we'll come back if you've got specific comment around what APRA have done, but at the highest level, we have a high household debt level, we have a high household debt to income level, and it's the income that is one of the most, it's not just servicing, but it's the fact of whether you do or don't have a job and whether you can actually have an income to service that mortgage. So it's not just about the level of the interest rate. In fact, that is one of the more resilient parts to the machinery. It's about, are you still employed? Have you had an unanticipated disruption to your income? That is what causes the most significant challenges from the very high starting position that so many OECD countries and New Zealand in particular find themselves in with high household debt levels. And that is the stress testing points that we highlight when we work with people. We give them unemployment numbers that look historically unusual, but for someone my age, quite relevant around if unemployment goes back to certain levels. Around the APRA, Chris, any comment?
Yeah, so you're right. We don't have requirements in New Zealand about the same sort of interest rate stress tests banks running. But in practice, all banks do have a test interest rate that they use in their loan serviceability assessment. We look at these rates in our overall assessment of lending standards. So this is one of the aspects that determines how much banks are willing to lend. So we look at this along with all of their other standards. And when we're making things like LVR decisions, we're assessing, are their lending standards prudent overall and are they appropriate? So we would be looking at whether there are any changes to that rate as one of the factors that we may consider in future LVR decisions.
And just
Have there been any changes in those rates or those standards recently that you've noticed or are concerned about?
I think I just clarify that what APRA did was they removed the minimum. It had to be 7% or more. They've maintained a requirement that's a 2.5% interest rate buffer on top of current rate. So there's you've got to have loans that be able to service a loan that might cost you 2.5 percentage points more. So there's still quite a conservatism there, which is appropriate, and it's just not quite as it allows it to vary as interest rates change a little bit more than having a hard floor that they had previously. What we're still expecting is banks to maintain that conservative testing, that they are resilient to interest rate swings. Interest rates can easily swing, a couple of 100 basis points to 3 percentage points over an international cycle or more. So you do need that, and as Chris says, we see that and we check that in our lending standards. So no substantive change in practice at this point.
And I guess taking a long-term perspective, we've seen these rates increase quite a lot over the last 2 to 3 years, and that's part of the general tightening in lending standards that we've seen, and that's why we've seen a gradual reduction in things like high DTI lending as a result of these changes. So we haven't seen any easing recently, but it's increased over the last 2 to 3 years.
I just want to bring it to an end there. I do want to finish because, a little bit of tension in the air here with some journalists. What I want to point out is that we are very transparent, we are very open-minded with regard to this capital requirement. But we need to rely on facts being reported and also some decent questioning of some of the statements that come out. So we will be working very hard with the team here around doing the appropriate thing for New Zealand, but I will be short where I see just continuous misstatements coming out, whether it's from journalists or people who have particular vested interest. So that is just the nature of the challenging position we're in to fundamentally improve the financial resilience of this country. So thank you very much, Mitaki.